Hi, my name is Yogini Patel, and today I will be discussing Company E, Fast Track, with Jacob Kaiser and Stephen Smith today. So more specifically, I'll be talking about the financial performance, and then Jacob will talk about the strategic vision, performance targets, competitive strategy, production strategy, and finance strategy of the company, and then Stephen will end with our strongest competitors and the lessons we learned throughout this process. So talking about our financial strategy, I will use 6 measures to discuss the financial strategy of the company. So I'll use annual total revenues, annual earnings per share EPS, annual return on equity investment known as ROE, annual credit rating, year-end stock price, and annual image rating to discuss the financial performance of Fast Track. So starting with our annual total revenues, our average was $489,930 over years 10 through 20. As you can see in the graph, there's a significant drop after year 12. And this is because our company was not able to generate enough revenues because we had a lot of expenses, mainly from marketing. And so this caused us to lose a lot of profit, and we weren't marketing enough to be able to generate a lot of revenues. And we were falling behind compared to our competitors. But throughout all of it, Latin America was our strongest producing revenue region, and this is because we had the lowest expenses in Latin America. And we were able to gain a bigger market share there. Now, talking about our annual earnings per share EPS, our average EPS was $1.20. EPS is calculated using net profit divided by number of shares outstanding. Our net profit decreased after year 12, and so that is why in years 13 and 14, as you can see in the graph, our EPS is negative. And this is partially due to, as I had mentioned before, that our expenses increased a lot and we were not able to generate enough profit. And so this greatly hurt our numbers. And annual return on equity investment, ROE, our average was 9.21%. ROE is also calculated net profit divided by shareholders' equity. And as you can see, the graph has the same pattern as the previous one for earnings per share. And this is because net profit is a big factor in these calculations. Net profit affects our financial performance, and it is an important measure for our financial performance. And so because we were not able to generate a lot of net profit, our numbers are on the lower end for our company. Now, moving away from net profit calculations, our annual credit rating, our average was a B. Our average debt to asset ratio was 0.28, and we had a higher risk of default. And this is because we took out loans. In year 11, we took out a 5-year $50,000 loan. In year 15, we took out a 1-year $10,000 loan, and in year 16, we took out another 5-year $100,000 loan. You can see in the graph that our lowest point was year 13. At this point, we had a lot of loans and a lot of debt, and this put us at a higher risk of default. And so our credit rating was lower. But after year 13, we gradually started to improve, and this is because we started to pay off our loans slowly. Now moving on to our year-end stock price. Our average year-end stock price from years 10 through 20 was $17.38. But if you focus only on years 15 through 20, our average stock price was only $6.03. And this is mainly because we were not paying out dividends. We were having a lot of, we had a smaller market share. We were not producing a lot of profit. Our total revenues were smaller compared to our competitors. And we only paid dividends in years 10 through 12 and in year 16. And we only paid dividends those years because those were the only years that we had enough cash flow to be able to pay dividends to our shareholders. Now our annual image rating was an average of 67.9. Our image rating is consistent of 3 things. It is made up of corporate social responsibility, our market share, and the average SQ rating. We got 2nd place for the Corporate Social Responsibility Award from years 14 through 16 because we started to implement a lot of corporate social responsibility procedures. We became more energy efficient. We started using recycled packaging. We implemented a code of ethics, and we really started to hit home on corporate social responsibility and made it a priority. But on the other hand, we had smaller market shares, so that hurt our image rating, and our average SQ rating was only 4.9. And this is because our strategy was to have a more affordable shoe. And so our SQ ratings were lower and we offered lower models. And our image rating was hurt in years 13 and 14, but that is also can be seen all across the board with our financial performance. We were all down in years 13 and 14, but slowly after that, we started to regain. Now I'll hand it off to Jacob to talk about our company's strategic vision.
All right, thank you, Yogini. Now we're going to be talking about Fast Track's strategic visions and kind of how they've evolved over time. So our first strategic vision comes after year 13 when our company kind of experienced a lot of significant losses. And this strategic vision states that Fast Track hopes to increase its market share by implementing a differentiation strategy. This strategy will entail cutting expenses and using the cash to purchase other investments that could give Fast Track a competitive edge. These competitive edges include investing in celebrity endorsements and bettering relationships of our retailers. So some key points to take away from the strategic vision is that, for one, we wanted to differentiate ourselves against our industry competitors. And we did this by using expenses that were cut from selling our North American facility to invest in celebrity appeal and retailer relationships. And by retail relationships, we mean things like retailer support and customer rebates. We thought that investing in these aspects that weren't really being fully taken advantage of by other companies would set ourselves apart. However, this strategy did not work out as well as we thought it would. And that brings us to our strategic vision, which started in year 17, which states that Fast Track will offer more affordable shoes by providing a more limited selection than we did before. This will allow Fast Track to employ lower prices and invest in marketing strategies to increase our market share. Fast Track will further use a low-cost strategy by focusing on geographical areas with lower production costs, such as the Latin American and Asia-Pacific regions. So the key difference from the other strategy is that we were focused solely on lowering our costs, and we used this cash that was saved from lowering our costs to investing heavily in marketing because we wanted to increase our market share more and keep up with the industry average on that. And we lowered our cost specifically by buying a plant in the Latin American region where production costs were lower and kind of using that. This brings us to our performance targets for each of the years that we set our strategic visions for. As we said before, our first strategic vision didn't really meet our expectations as we wanted it to. Although a lot of our aspects did increase because of the strategic vision, it just didn't increase as much as we wanted it to or that we were comfortable with. So after we employed our more lower cost focus strategy in year 17, we did see a lot of our targets were met, such as EPS, ROE, credit rating, and stock price, specifically in year 17. However, we also did see some targets met in year 18. Unfortunately, none of our performance targets were met in year 19. This was specifically because of high exchange rates, which affected our Latin American markets specifically, and also our production plan. So this brings us to our different competitive strategies, and we'll start with our internet market segment, which was pretty consistent throughout all the regions. And since we've focused mainly on wholesale market, we didn't do too many changes to our internet market strategies. However, some notable changes were that after our market share drop in year 13, we've begun to offer free shipping, which we did see kind of affect our market sales a little bit. And we also were sure to maintain consistent search engine advertising that were kind of on par with the industry averages. After this, we also were sure to keep all our internet retail prices 40% above retail prices so we could keep our retailers happy. And now moving on to the wholesale market strategy, we began by focusing on a broad low-cost strategy. However, after moving into this segment, we noticed that there was a lot of heavy competition by another company, so we decided to reposition ourselves to a more best value strategy, which was kind of mid-quality, mid-price. However, this was around year 13 whenever we had significant losses, so it didn't really work out for our company as much. So we decided to employ our first strategic vision with the differentiation strategy in year 14, which we decided to build up celebrity appeal, retail relations, stuff like that. And as we said before, this was somewhat effective. We began building back up some more market share, but it just wasn't enough that we were happy with. So we decided to employ a narrow low-cost strategy in year 17, as we said before, and this offered the less variety and opened up production plants in cheaper areas, stuff like that. And we also invested more heavily in marketing. And we can kind of get a clear picture of where our company was kind of positioned throughout our time. You can see our first low-cost broad strategy in year 12, and we were heavily competing with with company C. And so we decided to reposition ourselves around year 13, year 14 to the middle more, which unfortunately was not very good for our company. And so as we were building ourselves up after our strategic vision in year 14, we noticed that company A moved out of the lower left quadrant. So we decided to take advantage of that and move to the left and start building our company up from there. And this brings us to our production strategies that we employed. We didn't focus too heavily on production strategies. However, in the beginning, we used primarily the North American Asia Pacific production facilities that we started with. And in addition to this, we decided to utilize some production improvement options, such as reducing the production setup cost by 50% and also reducing rejection rates by 50%. After our losses in year 13, we decided to sell our North American facility and replace it with a Latin American facility in year 15, which kind of influenced our decision to move into our low cost strategy in year 17. And then for our finance strategy, we primarily use debt to finance most of our investments that were made. We didn't take out any more equity or anything like that. One notable strategy that we used was in year 16, around the time that we were going to employ our second strategic vision. We took out a large sum of long-term loans, and we used it primarily for meeting the industry average for marketing and also making more celebrity expenses to match the industry average. And also towards the end, whenever we finally saw our EPS grow and we saw more consistent profits, we started using some of the loans as well to help us pay more dividends to shareholders. And so now I'm going to hand it off to Stephen to talk about some of our competitors.
All right, and I will be looking at the competitors that our company faced in the simulation and kind of determining which ones were the strongest and the closest, depending on the region or segment that we were in. The strongest is mainly based on the overall market share of the company, of course. So whichever company had the most market share, of course, a certain region or segment was the strongest, and closest is mainly dependent on market share, but also number of models, price, and the SQ rating of the company. So these are the companies that kind of operated closer to us, and the closer competitors are definitely the ones that we need to be looking out for moving forward. So starting with the internet segment, we wanted to go to year 20 and kind of backtrack a little bit and see where we ended things off to kind of see our competitors towards the end. The top row here is year 19 from Latin America, Asia Pacific, Europe, Africa, and North America. And then the very bottom is year 20. So you can see the different transitions from year 19 to year 20 where we left it off. The first thing that sticks out is the strongest company overall across the board is definitely company C. But another interesting thing is that our closest competitor across the board in our internet segment was company B. So you can tell the market share that we gained by being alone in our little lower left-hand corner there, but we definitely need to be looking out for competitors like company B and make sure that they aren't moving to take our market share in any way. So definitely paying close attention to that is important moving forward. And then looking at the wholesale segment was what we mainly try to focus on throughout the simulation. So with that being said, we are able to see different close competitors. I think that's mainly dependent on the strategies that we made in this specific segment. So you can see the strongest competitor in the market overall was still company C. So they definitely maintained their position throughout in this year, and it ended off being very strong. But our closest competitor in Latin America was company B, and that can be said in North America as well. But we also started to see company A in Asia Pacific, and then company D in Europe, Africa. And looking into the private label market, our company only decided to use private labeled products the first 2 years. So we decided to drop them in year 12. And we did this in order to kind of put more resources into our internet and wholesale market. It was just dependent on our strategy. And moving forward, we do think that for years to come after year 20, it would still be wise to not pursue private labels, as it just isn't suitable for our company's overall strategy. But looking at the strongest competitors in the market, you can see that Latin America had company F, as well as Europe, Africa, and North America. which is something new, as we saw in the previous two segments that company C pretty much dominated. Able to see the emergence of them towards the end there, with company C still having Asia Pacific. So it's interesting to see because none of these competitors were close to us at all. And I think that is mainly dependent on us opting out of private labeled products. It was interesting to see that they aren't close to us in any other segment as well. So the strongest competitors, company C in year 12 was our strongest competitor in the beginning. Our biggest competitive feat. It caused us to reposition ourselves and kind of switch from the best value strategy that we had. We definitely had to rethink our decisions, and it put us at quite a bit of a loss. Following that, company A, while we were facing hard losses, we were moving towards the direction of company A. And so for a second there, it was quite difficult and we had loss. But luckily, we switched places with company A as they moved towards the right end of the positioning map. And so we were able to kind of maintain our position in the lower left end, in the lower left end corner. And that is where we were able to start thinking about building up and kind of really utilizing the strategy that we switched to. And so company B, as we just saw, we didn't really have close competitors towards the end. That was mainly due to the fact that we were kind of alone in that little left end corner, but dependent on the decisions that were made, and pricing and SQ rating, company B was the closest overall that we found. So definitely watching that company closely, focusing on this new strategy would be, this new narrow, low cost strategy would be important to make up for the losses that we face from competition. So strongest competitors for the next 2 years, since we mainly focused on Asia Pacific and Latin America in the wholesale segment, that's kind of where I wanted to look at this for the next 2 years. Overall, we think that continuing to slightly lower cost to attract price sensitive buyers would be important. As we are in the lower left end section, we are able to kind of specialize in that area for sure. And then as well as continuing to take out loans to pay dividends to different shareholders. We wanted to make sure that our shareholders are happy. Our credit rating ended up being pretty well towards the end. So continuing to make sure that shareholders are satisfied is something that is very important moving forward. And then looking at the charts here, you can see highlighted that in the wholesale segments towards the end in year 20 that we lost 135 of the pairs due to stockouts in Asia Pacific. And then you can see as well here, we lost 305 due to, we lost 305 due to stockouts in Latin America. So kind of specifically thinking about stockouts in terms of competition, since that's something that we kind of ended poorly on. We don't want to increase our wholesale prices at all because our wholesale prices are pretty high when looking. So 58 in the industry, while there are definitely lower ones. And then in Latin America, you can see 63. So our wholesale prices are pretty high. So in order to combat these stockouts, we think the best option is to cut back on marketing to kind of decrease the demand so it's able to meet supply so we aren't wasting product. And then some of the lessons that we learned, we broke it up into managerial and just overall BSG ones. But starting off, marketing decisions early on are crucial to the longevity and success of the company. We didn't take marketing as seriously in the very beginning, and it was definitely something that we saw drag us down a little bit. And once we were able to kind of realize the importance of marketing for our strategy, as strategies began to change, we took out quite a bit, and it led to loss, as Yogini kind of mentioned previously. So making sure that we make those decisions early on would have been something that helped out a little better. Consistency is key. So corporate social responsibility, we were able to remain consistent mostly throughout the entire simulation, and we won awards for it as well, and bonus points. So it definitely helped us out to kind of maintain the same strategy throughout there. But consistency with our strategy, since we changed to a low cost strategy, kind of in the middle of everything, it definitely changed things for sure. If we were able to focus on a strategy and kind of maintain it throughout, it would have helped out a lot. If we were able to just specialize and definitely prioritize our where we wanted to be on the map. Another thing is act early and try to dominate the market share. So obtaining first mover advantage is something that we think was very important for other companies to kind of retain their market share throughout the simulation. So to be able to do that would be very important. So I think the very first steps you make are something that's very crucial. And then paying closer attention to the exchange rates and tariffs. I think that's one thing that we didn't really think that much about. It was definitely considered, but in the grand scheme of things, we think it got pushed aside. So we did have some issues with exchange rates and loss. So kind of reading the player's guide just a little bit closer with exchange rates would be important to if we were to start again, for sure. And then overall BSG lessons learned, it's crucial to pay attention to others' moves in every region. Don't focus solely on your own positioning. Definitely closely watch other competitors and see what they're investing in and selling in and the choices that they're making, and think logically about what that means for your company is something that's very important. And then finally, never make assumptions without proper reasoning. I think being in business courses and definitely being seniors, whether you're a business major or not, you've learned quite a bit of what decisions companies can make to kind of maintain a competitive advantage. So I think not making those assumptions without proper reasoning is something that's really important. I think it's easy for us to do as we've had similar experiences and have possibly ran similar simulations to BSG. Definitely make sure that you're looking at the data because since it is a simulation, it's definitely a different environment, and you have to analyze everything that's going on in the environment, such as the exchange rates and everything else, and kind of anticipate your competitors' moves. But making assumptions without being very sure is something that, of course, may be at a higher risk and may cause you to not do so well. And that concludes our presentation. If you have any questions, definitely feel free to ask them to the group, and we will try our best to answer those for you. So thank you for your time.